Should we use the Parabolic SAR indicator to create a scalping strategy? Before I answer the question, let me introduce you to this interesting indicator and tell you what you should and should not use it for. I will also show you two PSAR strategies so that you can study them and maybe then use them in your trading if you find them suitable. Do not even consider trading with the PSAR before you know what I'm going to share with you on this video. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Okay, let's talk about the basics and theory first, and then I'm going to show you how you might want to consider using this indicator in your own trading and analysis. First of all, the indicator is pointing to rising prices when we have the dots below the price. And then when the market is moving lower, the indicator is placing the dots above the price. We also call this a parabolic curve. When the markets move sideways, we have more frequent changes in the indicator, so that this kind of shows you that this is not really helpful in the ranging markets if we're going to use it in the traditional way. And to be honest, this indicator is created for trending markets, not for ranging markets. So it highlights the direction and momentum. When you have bigger distance between the price and the dots, you have more momentum in the market, and then later on the dots and the price converge together over here and over here, and then you know that the market is losing momentum and could change direction. The name suggests you might be able to use this as kind of a basis for a stop and reverse system where you go short from a short position to long directly without moving into cash in between, or vice versa. But for various reasons that you learn in this video, this is not really recommendable. The indicator was created by Wells Wilder in 1978. His main principle was that the time is the enemy here. He borrowed the concept from options trading, where options have time value, so it doesn't make sense for you to stay in options positions for too long. Here we have basically a pound USD chart, and the indicator, it helps you to measure the momentum. In the beginning, the price moves higher, there's a lot of momentum, but then the price starts to move sideways. So the indicator converges to the price and highlights that this market is actually losing momentum, and you might consider moving away from your long position, and eventually you might start to short the market, which here would have been the right thing to do. Let's take a look at mathematics behind this indicator. So we have the formula here, but I'm going to break it down so that it's easy to understand. The elements we have here is the current SAR value, and this little alpha here is the acceleration factor that starts at 0.02, and then 0.02 is added to it at each new period. So if you're looking at hourly chart, then we're looking to add 0.02 at every hour. If we're looking at the daily chart like here, then at every new candle 0.02 is added to the acceleration factor. Then we have something called EP, or extreme price level. That's the highest high in an uptrend and the lowest low in a downtrend. So basically, let's take an example here. This candle high, for instance, that's the EP. The high of this candle is the EP. We take the difference between the high here and the current SAR value. Then we multiply this by the acceleration factor and then add the current SAR value to the calculation. That gives us the next SAR value. Like you can see, it's a little higher than the previous one. And that's how we have the indicator plotting these dots below or above the price. So it's pretty clear that Parabolic SAR is a momentum indicator. And at this point, it's highly important to understand that there are two types of systems in trading. The basic types of these systems are the same, even though there's multiple variations. And they are either momentum systems or they are mean reversion systems. When the markets are trending higher, they are in a momentum mode. And that's when the trending models or the trending strategies actually make money and mean reversion strategies lose money. Then when the market goes to sideways mode, then the momentum strategies usually lose money. That's basically because they try to buy at the breakouts and then the market reverses. Then they try to sell the breakouts and the market reverses. This is why you shouldn't use a momentum indicator or a momentum strategy in a ranging market. And that's why you shouldn't use Parabolic SAR with its classical rules in a ranging market. You might remember I said earlier that Wells Wilder said that this indicator should be used only in trending markets. And this is the reason why he said so. As you can see here, we have the price trending higher. This is Dow Jones in 4-hour time frame. And when the market loses momentum, the price and the indicator converge. They come closer to each other. So this clearly shows you how this indicator highlights the periods where you have lots of momentum and periods where you have less momentum. And then there'll be periods when the markets just move around, chop up and down in a range, and that's when you should stay away from trending approaches to the market. Okay, should we use the PSAR to create a scalping strategy? And the short answer is not on its own. Here's the reason why. This indicator is a trending indicator, and in a trending market where this indicator works, scalping is not an optimal strategy. And then when the markets range, like here in this chart, this indicator being a trending indicator doesn't give you the right signals. It gives you the wrong indications, so it's not suitable for range trading. Scalping makes sense where this indicator doesn't work, and where this indicator does work, scalping doesn't make sense. When the expected move is big, like here in this Euro USD 30-minute chart, in this example it was 4.4%. It really didn't make sense to take 0.5% or 20 pips or 30 pips out of this move because the market was moving big. In a trend, the expected move is significant, it's substantial, it's sizable. Therefore, you should employ, and that's what the professional traders do, they employ momentum strategies here, and when the markets are ranging, they employ scalping strategies. So for these reasons, I don't recommend creating a scalping strategy based on the Parabolic SAR indicator. However, if we add some other technical aspects or indicators, or we use the PSAR in a non-traditional way, then we can create something. And later on in this video, I'm going to introduce you to two different ways of doing this. Before I show you the trading strategy rules, I want you to understand the following. The rules here are based on solid price action logic, but they have not been tested statistically. You need to know this. So it's your responsibility to go and backtest these ideas and to see whether they fit to your own trading style. Also, this is not a fully automated system. It requires your own discretion to evaluate the market conditions so that you can establish whether the market is trending or ranging at the time of the entry. That basically allows you to choose which kind of strategy to employ in that market. Let's first take a look at how to scalp with the PSAR in a range. So remember, I'm not using the PSAR in its sort of original purpose. I'm twisting the rules a bit to make it fit to the environment. So as this is a momentum indicator, its use in range trading has to adjust to the mean reverting nature of price action. So when you have a range, that means that you have price reverting to the mean. There is no momentum. The price is reverting to the mean over and over again. In a mean reversion environment, buying at resistance and selling at support loses money. So we therefore need to do the opposite and buy at support and sell at resistance. So scalping in a range, we obviously first have to establish that we have a range. In this example chart here, this is Euro USD 1 minute chart, we have 3 points here. Market finds support here, here, and then there's resistance up there. So after this red line, it's safe to say that the range is established and we can start to employ or apply the trading rules. The rules for long entries are that you obviously wait first that the market is in a range, and then you buy the first green candle after the price moves to the low SAR. Here we have a movement to the lower end of the range. The market tries to break out of the range, but this is not a decisive breakout. Instead, we have a spiky candle here and then some inside candles. Inside candles, as you might know, they represent reversal potential in the market. And here the rule says you buy the first green candle, so the first up candle in this 1 minute chart. And then you hold the trade. The long exit rule comes here when the price reaches the previous or the current high in the SAR. So the SAR value up here is reached and the market sells off. So that's where you can exit the trade. And remember always to use protective stops. There's no point trading the markets with open-ended risk. It's just going to lead to you losing one account after another. So that's long entry and long exit rules for this strategy. And like I said before, you need to test these historically. Go back through the charts and see if it works. If you like it, if you need to modify it, feel free to do so. And only apply this in your trading if you are confident that it works most of the time. And the rules for short entries and exits are basically the opposite. We wait for the market to be in a range. After this point here, the vertical line, we can say that the market is definitely ranging or very likely ranging. Then we sell the first red candle after the price moves to the high SAR. Here we have a reaction to the downside. We sell this candle, and then the short exit comes when the price moves to the SAR value down here. So that's when you exit the market. And that's obviously, if you look back to the previous slide here, the previous chart, here we have something similar. We are basically just buying long when we have an up candle here. And here we are exiting when the market comes to the low candle, the low SAR value, and going then long on the first green candle. So in a range, you buy the lows and you sell the highs. Eventually, the market will break out from the range, so there'll be a losing trade. That's inevitable. There'll be losing trades, so that's the reason you have to have these protective stops in place. And this is one of the only certainties in the markets. They often say that there is nothing certain in the market, but one of the certainties is that there'll be a breakout at some point. so you need to prepare for it. But as long as the price stays in a range, it makes sense to take trades. Okay, then we look at momentum trading with the Parabolic SAR Indicator. So, as I have said a few times already, it's a momentum indicator. It's best suited for momentum trading, and in a trending environment, we look for buy opportunities in uptrends and sell opportunities in downtrends. That's because we don't want to be sellers in uptrends and buyers in downtrend, because those approaches lose money over time. Okay, so let's see how we're going to use this indicator. We're not going to use the stop and reverse function of this indicator because I don't think it's reliable enough. Instead, I'm using a moving average here to help us to figure out what the trend is, and then we look at the PSAR for entries. So this is effectively a breakout strategy. We wait for the price to trade above the moving average. You can choose whichever moving average length you like. I have 75 periods here because it's sort of a fairly steady. It doesn't chop up and down. It moves to one direction at a time for fairly consistently. And when the price is above it, it tends to stay above it for longer periods of time. And then the idea is that once the price is up there, we look to buy the first close above the high SAR. We hold the trade until there is a close below the low SAR. We buy again on the breakout, and then hold until there is a sell signal when the price closes below the low SAR. But notice we don't use the stop and reverse system. We don't go short, we just go long when the market is trending higher. Obviously, you are free to do what you like, but I always suggest that you backtest and research every approach that you are intending to use in your trading. And then the short entry rules, we wait for the market to trend down. Here we have the price moving below the moving average most of the time, and the moving average points to the downside. Then the first sell signal comes when the market closes below the low SAR. Here we have a sell signal that wasn't great. The market then moved higher. And then the next one was a little better. The market moved sideways until it then collapsed. But noticed here there was no exit signal. The short exit rule is that we buy the first close above the high SAR. And in this occasion, we had really nice signal here in terms of the movement that followed from it, because the next exit signal comes down here. This is where the market closes above the high SAR. And when you create your trading plan, possibly using this strategy, you might want to, or you have to decide whether you're going to accept consecutive signals in the same direction. Whether you just hold one trade or whether you add to it when there are other signals and then exit all the trades at the same spot. That's an approach that you might want to consider. But again, please always use protective stops. That was good stuff, wasn't it? Very interesting material, I think. While I'm preparing the next video, I think you should go and study the historical price action to see if these strategy principles would help you in your trading. And please remember that if you have any questions, you can always send me an email at support@tiomarkets.com. Take care now, trade well, and see you soon.